Okay, Unit 8, Lecture 2. We're going to talk about the stock market crash, the Great Depression, and the New Deal, FDR's New Deal. Okay, I've got a whiteboard for you right here. Okay, get some of these terms down. There's a lot of them. All right, the Great Depression then is a period of severe economic hardship lasting from 1929 to World War II, and we'll discuss later on the effectiveness of the New Deal and World War II actually pulling us out of the Depression. All right, there are a combination of factors that caused the Great Depression. Some of these causes are, number one, the 1929 stock market crash and the resulting collapse in stock prices. Two, the Federal Reserve's failure to prevent widespread collapse of the nation's banking system in the late 1920s and early 30s, leading to a severe contraction or shrinking of the nation's money supply. Money in circulation. Three, high protective tariffs, specifically the Hawley-Smoot Act, which you'll have to remember and should be up there, okay, which strangles world trade. And four, an overproduction. Overproduction of goods is going to be a cause of the Depression. It lowers prices, too much supply, puts debt-ridden farmers into foreclosure, and forces employers to lay off factory workers. So on the Great Plains, overproduction will be partially responsible for the Dust Bowl, which we'll talk about in a little bit. Okay, so the United States emerges from World War I as a global power. The stock market boom, this is referred to as a bull market, a long period of increasing stock prices, okay, stock values, okay, so the prices keep going up, keep going up, keep going up. So Americans are going to begin to borrow money to invest in the ever-increasing stock market, speculating is a word you need to remember, that the prices will continue to go up. They're going to bet that the prices are going to continue to go up, so they'll make money by selling those stocks and become wealthy. All right, so this this stock market boom, this optimism of the 1920s, were generated by investments made with borrowed money. All right, so when businesses fail, stocks are going to lose their values, prices are going to fall, production is going to slow, banks are going to collapse, and unemployment is going to become widespread. Okay, these are factors. These factors are going to lead to an excessive expansion of credit, which in turn will lead to investments made with borrowed money. All right, so many people realized that if they borrowed money, then they could buy even more stock. They could buy more stock with borrowed money. Okay, and after they sold their stock, they could repay their loans and still clear a lot of profit. This is speculation. This is also the practice of buying stock on margin, buying a stock with credit. Okay, so margin buying led to an over-speculation of stock, an over-betting on the increase in the market. Okay, so when the market dropped and the prices of stocks declined rapidly, the people who had bought their stock on credit and were speculating on increased market could not repay their loans. Okay, and left them in a difficult position. The terms of their loans allow their creditors to demand enough money to cover the stock's original value. So this forced investors to sell even more stock, and when you sell more stocks and more stock, it's on the stock market. When you try and sell, if I'm selling 10 shares of Coca-Cola, the price will be here. If I sell 100, it's going to go down here. If I sell 1,000, it's even going to be more, because the more supply, the less the price. Okay, and we'll go over this a bit in class. So remind me, ask me to cover it in more detail. So this downward cycle is, as creditors are calling in their debts, people are selling more and more stock. It's going to lead to the stock market crash in 1929. Okay, so 1929, it's Black Tuesday, October 29th, 1929. The stock market's going to crash. And it has a couple of causes. Over-speculation, like we were just talking about, fueled by excessive over-expansion of credit. Second, business failures leading to bankruptcies. Okay, and since banks had often, this is a third reason, banks had often deposited or used deposits to invest in the stock market, the banks had no money. Okay, when the market collapsed, they lost all their money too, because they invested it in the stock market. I'm going to pick up in a second.